everyone, to episode 68 of Top of Mind with Hao and Chris. On today's episode, we are going to be talking about a correction in the markets based on uncertainty.
And we'll talk about consumer confidence hitting a low, or delve into that more.
And we'll talk about the Maleficent 7.
Maleficent.
Sleeping
Beauty.
None of the Sleeping Beauties are beating the S&P 500 over the last quarter. Is the world ending? We will hope to address that today.
Yeah, I think on the back of that, these are dour topics. They sound dour. I think there's opportunity here, though, too.
Markets hate uncertainty, as we're going to get into in about a minute or less, and a lot has sold off because of that. So, yeah, I think there's two ways markets could go, and we'll unpack that all today.
Okay.
All right, cool. Well, today is March 21st, Friday, 1:55 p.m. Pacific, and let's dive into the correction that we've seen in stocks. So, Hal, why don't you kick us off? Just walk us through general markets and where things at.
Yeah, I pulled this data a day or so ago. Markets actually have been flat since I pulled this. S&P year to date is down negative 4.7. International stocks are up positive 11.48. That has come down a little bit more significantly, actually, since I pulled this data, but the direction is still relevant, right? And emerging markets are up 8% on the year. So some of the previous losers are suddenly winners.
Mm-hmm.
And some of the previous winners are suddenly losers. Is that going to hold?
Why do we think that is? Why do we think that international is up while the U.S. is down? Last couple of years, those things have been like positively
tough to own,
correlated.
Right? Yeah, and also tough to own because the S&P
too.
would do better. They're still moving the right direction together, but the S&P always had this extra head and shoulders above international, right? So it's like the questions we always got is, why do we own international?
Yeah.
Right? Why this is happening? A lot of theories, which we'll probably find out by quarter end when we get a lot of these trade blotters come through. Institutionally, it looks like rebalancing. There's just value in some of the recent laggards, right? There's value in international. And fund managers are just buying something that they view as cheaper. That's one theory. Mm-hmm. Another theory is a lot of sovereign wealth funds are actually based out of Europe. Believe it or not, there's countries out there that have surplus and that don't have debts like we do, right? Mm-hmm, mm-hmm. So therefore, they're investing their surplus. Mm-hmm. And a lot of them, from what I hear, are migrating those dollars or euros back home mm-hmm. or back to European-based companies. Germany is increasing their budgets to start using debt as a funding mechanism for the government. Believe it or not, Germany had a zero-based budget, meaning you don't take on any debt as a country or city, or I don't know if they have states, but if you're municipal running in Germany, you're not going into the negative. They actually loosened that, and now the German government can essentially double their spending power by going into debt. Mm-hmm. Other parts are Trump, where he says, Europe, you spend your own dollars on defense. Mm-hmm. And guess what? They're doing that, but they're funneling most of their investments or on the defense side to European government contractors, not U.S.-based. Mm-hmm. So everyone talks about how we're funding Ukraine, but that kind of helps U.S.-based defense makers, right? Mm-hmm. We're spending all this money for weapons and defense manufacturing on U.S. companies to ship over to Eastern Europe. And now Europe is playing that same game, but they're rewarding their own companies. So the market is obviously caught onto that and has rewarded international companies, at least broadly. And for me, I don't know if it's sustainable, because can you name a Google or Google-like company out there, or an Amazon-like company in Europe or Japan or anywhere internationally developed, right?
No, because they sell back to the U.S. Shopify, right? Shopify is the anti-Amazon's Canadian company.
Yeah.
But they sell back into the U.S., and their valuation is because of the U.S.
Yeah. And I'd have to look pretty hard. I know ASML is like a chip maker in the Netherlands, but that's probably the closest thing that they have to like an NVIDIA or even an AMD here, right? AMD is not the most exciting company, but they still are head and shoulders better than a lot of European companies in terms of like the tech side and growth and, you know what I mean, ingenuity that we're just not seeing out of Europe.
Yeah. Well, it's not, when you look at their indexes, they don't have as heavy of weight to tech. And I think part of that is just how things are structured there. You know, even the bankruptcy code here and the risk taking here in the U.S. is just different.
It's encouraged almost here, right?
I heard this recently, actually, in 2008, walking around Manhattan, and people are freaked out because they just lost their job because the bank failed. I don't have health insurance. I can't pay my mortgage. I can't pay for my kids' childcare. Whatever it is. And it was this panic of like, I can't fund retirement. I got to get back to work. I got to get a job. Go to Europe, and it's like, well, my health insurance is taken care of, my retirement's taken care of.
Yeah.
Childcare's free, or I don't know, whatever. And it was just less of a panic. And so that sort of boom and bust that the U.S. is created just with their capitalistic economy is in part or in whole what has created these massive companies here because of that risk taking.
Yeah, and over there they have a little bit of higher floor. So if you do bottom out, it's not dire straits, right? Because here, yes, there's some backstops like unemployment and things like that, but the floor is incredibly low. Because if you fail, you're a small business, that's starting over is very tough prospect here.
For sure. Do we have any insights on, so there's been a lot in the news about Canada, for example, is pulling U.S. products from their shelves. Countries are saying buy local, don't buy U.S. Do we have anything that's actually proving if that is happening much, or do we just not have that data yet?
Yeah, all anecdotal and through pictures. I know Canadian liquor stores are state-run, so they can say, hey, don't sell this product, and they'll pull them off, right? How much Jack Daniels were Canadians buying in the first place? I don't know. I don't know, but I know the CEO of Jack Daniels was very vocal about, not even having a chance to compete against other whiskeys because they're just not making an option to buy. Whether it has a, substantial impact, I don't know. We won't know until probably the next few quarters. And I think the biggest thing is even today, it's a Friday, and all of Trump's advisors are saying wait until April 2nd to firm things up. And Trump today came out and said, well, we're going to be flexible with our tariffs. And I think the whole point of the sell-off was not really the tariffs. It was the uncertainty surrounding the tariffs, right? You turn them on, you flip it off, you turn it on, and you flip it off. Then you start making exceptions. And you really generate this fog that it's hard to operate an investment or operate a business, right? There's so much unknown right now that's really what we're trying to point to with the market volatility. And I can tell you, if Trump came out whenever he announced tariffs and said 1,000% tariffs on every other country outside of America, like ripping a Band-Aid off, we probably would have had a sell-off, but most likely the rally would have continued because the certainty is back in play, right? If he was just sticking to 1,000% tariffs, as harsh as it sounds, the market will adapt. They'll find new trade routes. That's what they did in 2018, right? Everything's funneled through from China to Singapore. Now suddenly there's no tariff, right? That's kind of not an open secret. And as long as everyone knew what the rules were, they were just moving on with their day, right? Because pretty soon after 2018, NAFTA was torn up and NAFTA 2.0 was written, right? And 2019 was a pretty strong rally. So that's because uncertainty was really a non-factor after all the noise kind of settled down.
I'm kind of with you on this. I think, and we talked about this so much internally and even on the last pod, but really what's causing a lot of this market volatility is just strictly the uncertainty of where does the tariff policy land? Because we don't have that, right? We have it's on, and then it doubles, and then it's paused. and then it's going in force on a date, and then it pauses or it doubles, there is no certainty on that. And to your point, if I'm a CEO of a company, I just need to know what the business environment is to be able to operate.
Yeah.
Make my next hire, grow my team, run my product. How do I run my product profitably in a tariff environment? I mean, if he just came out and said, this is the deal and this is what I want for it, that would be so much easier for companies to plan around. But they don't know what to plan around. And that comes back to markets hate uncertainty. We're in an uncertain environment. And so there's that sell-off. If we can get some clarity on this, I think that's
off to the races, right? Yeah.
Off to the races. Yeah, exactly. Okay, great. I can plan around that.
Yeah. And just to address that head on, I know people are saying, what if it gets worse? There's a good chance of that happening. And the people are raising their recession probabilities, but this does rhyme with what happened in 2018.
Right.
We didn't get a recession in 2019, or we did get one in 2020, but that was pandemic fueled.
Right.
If we didn't have the pandemic, well, we actually did have the pandemic, and we had a great 2020.
Crazy. Yeah. Well, that was juiced with money, though, too.
Yeah, a lot of injection of cash directly to the hands of consumers, right? But even before then, we had a pretty strong rally, right? That was on the back of tax cuts, which coincidentally is back in play this year. And if you kind of somehow get past this, which you will, and look back and say, well, February, March were probably unnecessary, but man, that was a good time to buy lower.
I was just trying to look up consumer spending. We're going to get into this in a minute, but consumer confidence related to consumer spending, that is something that could erode and then could draw us into recession. And it could be this back and forth, just creating uncertainty. You've got the airlines coming out and they're already saying, hey, we had, I don't know, 95% capacity and now we've got 85, and that's a problem.
Yeah. Yeah.
So does that mean prices come down? Yeah, I don't know, but I think it does hit their profitability.
Yeah.
So, it's interesting.
We also have the Bank of America survey to address your first question about how European and emerging market stocks have done. Bank of America does get a pretty widely followed survey of professional money managers, and they're saying where they're allocating, right? Many are cutting their U.S. equities by positioning by upwards of 40%, which, one, if you're a money manager swinging that hard, you're probably not doing it right.
That's crazy.
That's probably looking at hedge funds as well. I know hedge funds were dumping U.S. stocks, but again, just look at the history of hedge funds. They just haven't been very good money managers.
Right.
And then upwards of 27% is going into Eurozone, 23% going to UK, and then 20 to 21% going to emerging markets. And this flags to me as hedge fund. About 18% of that is going to cash.
I don't like that idea.
Stupid. Yeah. Again, these guys charge high fees, and a lot of times they just don't. One, they don't last very long, right? Chris and I are doing a lot of work on private investments. You wouldn't imagine the amount of funds out there that are springing up, but if you search through them, the amount of funds that just shuttered and closed off, and it's because they have people like this running money for probably family offices or more, I guess, well capitalized parts of society, but still, I wouldn't want anyone swinging a 40% U.S. exposure down to nothing. That's pretty bad.
I think we're in an era where investor mistakes are going to reach an all-time high.
Yeah.
I mean, the news is on your phone. It's on your browser at work. It's on the little thing in the bottom left of Windows when it says, blah, 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 something happened. And it's just like, it is everywhere. I was even up in Canada recently, and I'm at the gym, and the treadmills are all about the news coming back to you can't escape it. And I think the level of investor mistakes, because the average investor trades on that, and it's so
let's define the less retail investor mistake. What's that mean to you?
Vanguard has a study on this. Their S&P 500 fund does whatever it does a year, but the average investor in it only earns like 1 or 2% annualized. And obviously the S&P does more than that annualized over long periods of time. And it's because the average investor is hopping in and out, and in and out, and in and out, and they're trying to time markets. And I just think we're in this era where it could just be rampant. And I mean, we're fortunate to where we really don't have a lot of clients reaching out to us during these times. We get a handful. And it's really just hey, what do you think? We don't ever have anybody reaching out saying like, I got to go to cash, get me out. It's just, I mean, I think the people that ultimately work with us are kind of believers in long-term diversification, keep a level head. We'll do a rebalance when we see fit.
Most have been with us through 2020 and 2022.
That's true too.
Yeah.
Yeah, that's true too.
2022, everyone forgets that was a really bad year, right? The S&P was down 18% by year end.
And bonds sucked. Bonds had the worst year in 100 years.
There was nowhere to hide, right?
Nowhere to hide.
Yeah.
And so you actually should have gone to cash in hindsight. But you never would have made that recommendation because it didn't make any sense, right?
I could tell you people scared in 2022 that went to cash are still in cash, missed 2023 and 24.
That's the thing about going to cash is it's not about going to cash. It's about going to cash and buying back in. There's two trades.
Yeah.
There's the I'm out and then there's the I'm in. And the I'm in is when the news gets better. And by the time the news gets better, markets have rocketed. I mean, it's what, March 9th of 2009 was the bottom. I don't think unemployment peaked until like 6 months later.
Yeah.
And the market was way higher. And it's just, you can't time it with a high degree of certainty.
Yeah. So mistake one ends up being right in the very, very short term, right? Because if you sold out at negative 8% and the market goes down to negative 10%, you netted
You feel awesome. Yeah.
Yeah. You're the smartest person in the world.
Yeah.
Mistake number two comes when the media puts out pretty dire headlines because the stock market is selling off even sharper. The guts it takes to take that cash and go back in. I know from firsthand experience with clients, with myself, not as easy as you think it is. It's always easy in hindsight. I could always go back and say, 2009, I should have invested. One, most people were worried about their job security than investing. So take that bravery, that hindsight bravery out and try to test yourself in the moment, right? Mm-hmm. Because I know we put out a call for cash, which when we say, hey, the market's down X amount, you should buy low. Yeah. We did that May of 2022. Yep. We did that proactively, and I could tell you we got 0 clients asking to put more money in on their own accord because that's scary, right? 2022, if strip out what happened in the next 2 years, everyone came into 2023 thinking recession was inevitable, right? 100% of economists polled said we're going to get a recession.
20 out of 10 economists said we'd have a recession.
And they're
it's
all
a leverage
wrong.
bet.
And now I'm seeing, I was one of the few economists that said there was going to be no recession. BS.
Right? It's something you got right. You didn't give yourself credit for. In our article that we said everything you predicted was wrong, but you should have just slipped that one in there.
Yeah. So 2022, probably the last great buying opportunity. But I could challenge you when things were really bad, when the Fed was raising rates, two rate hikes at a time, like 0.5% at a time, which is so unprecedented. Inflation was peaked at 11%. I could promise you no one was happy and no one was willing to buy. Right? So that's the opportunity staring us in the face now is, will this 10%, potentially 20%? I'm using 20% because 2018, it bottomed in December, Christmas Eve, right? It bottomed. And you know how long it took to recover the S&P from that bottom of negative 20% December 2018?
3 years, 36 months. No, 2018.
Yeah.
No, I do not know. I was going to guess. I don't know.
6 weeks, barely 3 months. It recovered by February 2019. All those losses recovered. So those I want to call them cyclical recessions. Those or bear markets, those are easily correctable. All Trump has to do is not talk for a little bit.
He's like Jay Powell.
Yeah. The market will we'll forget about him and move on, even as a president.
For those that don't know, every time Jerome Powell's the Fed chair, so he comes out and announces what the Fed's going to do with interest rates. So every time he would come out, he would announce something, and then the market would like usually react, not much or whatever, and then he would keep talking.
Yeah.
And the market would just move based on the stupid things that would come out of his mouth. And we were like, just come out to the stage and be like, we're going to raise rates by 0.25%. And then just go back. Just like Mike drops you later. Like, just stop talking. And Trump's kind of the same thing, you know, just like announce what you're doing and just stop talking, dude.
Yeah.
You're swinging markets too much.
No, yeah. And, they're increasing uncertainty. And that's all we're saying is uncertainty does have a tendency to go away. It's always something new, right?
Yeah.
And I think if you're just looking at that, simplest form of the definition, slap on tariff, slap on a whatever COVID was, tariffs round 1, tariffs round 2, Ukraine, you name it. There's always reasons to sell.
Oh, yeah.
And all those reasons all point to one thing. Uncertainty was heightened, right? So the best times to buy generally are the scariest times to buy.
Yeah.
So that's what we're saying is look at this as an opportunity. In the long term, you will probably thank yourself.
When your little bottom left corner of your computer flashes a thing called the VIX, you don't even need to know what that is. Email us and send money in. When the VIX is in the news and it says it's VIX is up, send money in. That's a good time to buy. Okay, we got to roll. Consumer confidence hits a new low. This will relate, I think, to kind of what we were saying, but let's just hit it quick.
Yeah, we did this a couple years ago.
Yeah.
2022, it bottomed, and I thought it was crazy because people were saying that this is worse than the housing crisis, right? The consumer confidence hit 50. Stock market over the next 12 months did 17.8% up.
Yeah, which doesn't suck.
And right now we are down to 59, 57, which is a pretty low. Again, go outside and figure out how to wash away the news headlines. Does it feel like a recession to you? Go to the mall. Go to whatever restaurant. Not round robin. I hear they're closing, but like go to a sit-down restaurant and see how packed it is. Red Robin.
No, Red Lobster's closing, isn't it?
Red Robin is too.
You know, that's a Seattle-based company.
Yeah, private equity owned.
First one was down in Lake Union, and I'd been there a handful of times because I went to school at UW.
But have you gone out like anywhere with your family? How crowded?
Oh my God,
is anything?
crowded. Yeah.
Yeah. So 1, figure out how to get outside. 2, kind of erase all that we're seeing with Trump and Doge or whatever the hot button issue is, and kind of get a sense of how things feel. Right. I took my daughter and son to a birthday party at a bounce house. It was old carved out Walgreens, packed to the gills. Right.
Interesting.
And it was like a $20 entrance fee. Not a single person blinked at that. Yep. Consumer confidence is now at 57.9. We're just saying is when the consumer confidence bottoms, the next 12 months tends to be pretty good returns. It's the flip side we got to watch out for. When consumer confidence reaches like 110, returns over the next 12 months are pretty condensed, right? When things are good, things are more expensive in terms of an investment. That's why you really want to be careful about being over jubilant when things are good, and also be too down when things are bad or feel bad.
June 2022 was the last low, hit about 50.
Yeah.
And then from June to...
Go back to this episode, Chris and I, we were proud about that. We said invest now, right?
That is true.
So, again, we're not get every single one of these right, but when things feel bad, throw money at it, which is kind of a stupid thing to do in real life in the investing world.
But this is what we tell people, right? Like, it feels crazy in real life. It feels like you're catching a falling knife, and it's gonna, the day you buy, it's gonna go down. But then zoom out. Let it chill for 6 months and zoom out. And we make a point to go and look at it. If a client, if we send that call for cash and a client says like, hey, here's some money, we look at their accounts since that date and moving forward, just to look at it like, hey, you sent in money here and it probably felt like the craziest thing that you've ever done in your whole life. And look at what it's done between that date and here. And it's always a great number. And it feels awesome, right? Like, these are opportunities to buy with valuations that were,
Yeah.
you didn't,
To be fair, most of our clients are throwing in cash to their 401ks every 2 weeks, and
Yeah,
also
true.
their stock grants every quarter. Like, so they have this systematic rhythm.
Yeah.
That's probably even better. Who cares about
Yeah.
what the market's doing at the time?
I think this is one of the risks, though, just to hit that point. So we talked earlier about how if we can get some clarity around tariffs, markets should be able to plan around that and hopefully see prices go back the other direction. I do think that there's a lot of pressure, specifically on big tech this year. We said this last year, and we made it one of our predictions, but Wall Street's going to start to say, show me the money on AI. These companies have doubled down in Q4 that they said next year we're going to spend X billions on our build out. And we think that this year is going to be the year where Wall Street goes, okay, that's great, but like, is a $30 a month premium on Copilot going to actually make you money to pay for that? Right. So we don't know yet.
For that?
Yeah. But obviously these companies have carried premium valuations for a lot of years. And so, I think Wall Street.
They carried the market too.
Carried the market too. So where am I going with that? So consumer confidence is down. Now, if that actually bleeds into consumer spending in a increasing and durable rate, which means people aren't traveling, people aren't flying. They're saying, hey, instead of flying somewhere for the vacation, going to Disneyland, let's just drive an hour and a half and stay close by. Let's do something cheaper. And consumer spending drops, we could see a recession because consumer spending is ultimately what powers the U.S. economy. Probably the good news or the silver lining of that is the data would suggest that the U.S. consumer is actually in a really strong place. So hopefully if that happens, and then the sentiment swings the other way, spending returns, and we pop back out of it. We don't know. We aren't here predicting a recession or not. But anyway, I think those are the two outcomes. We get clarity on tariffs and things kind of bubble the right direction, or consumer spending continues to erode. Consumer sentiment continues to erode. Consumer spending erodes, and we actually fall into a recession. Your thoughts?
Yep. Remember the Ukraine conflict started in 2022, and everyone was really scared. It was the beginning of the year.
Yeah.
Still going on. Market has gone higher since then. So even if there's no resolution to certain things, tariffs obviously should have a resolution. But you see what I'm saying is the market forgets and moves on. And you got to be market-like, right? You got to be somewhat unemotional about it.
Yeah. All right, talk to me about the Maleficent 7.
Yeah, same 7 stocks: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla. They're no longer magnificent, at least for the time being. All 7 stocks are lagging the S&P over the last month, or over the last 3 months, to be clear. There was a stretch where, starting in 2023, all 7 were beating the S&P. Mm-hmm. And they were carrying the S&P, which I know I'm asking people to go back and listen, but Chris and I have been talking about how unsustainable that ultimately is. Mm-hmm. But I think this is where we were wrong. Once these roll over, S&P needs to roll over. That hasn't been the case. I'm going to read off the percent off high. Like Tesla's down 50, Nvidia's down 22,
50.
Amazon's down 19, Apple's down 18, Alphabet down 21, and Meta's down 20. What would you guess S&P's down?
4.
That's year to date, but yeah, from the previous
from the high?
top. Yeah, from the high.
9.
Yeah, 8.75. Mm-hmm. And so the S&P is basically lapping Nvidia, or Apple, the next best performer. But that the fortune telling that we did in 23, 24 didn't come true, thankfully, right? Because I said if Apple sneezes, the S&P gets a cold. This is definitely more than a sneeze, and the S&P is like the thing to own. So what we're seeing is people are rotating out. They're buying value. They're buying consumer staples, right? They're buying things that are cheaper, and sometimes that happens. Are these companies still great? In my opinion, yes. I know we have some bugaboos about Tesla, but still, it's the collective 7 still is screaming potential sale right now.
Hey, one of my predictions for 2025 is that the Mag 7 was going to get a new name. So I'm not going to call that one a green check at this point.
Maleficent 7.
Maleficent 7, I'm not satisfied with that. But, I think that it's just not going to be the Mag 7 anymore. Maybe it's going to be the something 6 or the something 5 or the whatever. And so...
Ironically, tariffs might not hit a lot of these except for Tesla, which is ironic. And then maybe NVIDIA because they're so hardware or durable goods based.
What about Amazon though? I mean, Amazon has so many products coming from China.
Yeah, but what's driving Amazon's performance lately? It's been AWS. And can you tariff a subscription? Can you tariff code? I don't know.
Well, fair. Yeah, I mean their retail division has to have a huge percentage of imported products that they're selling.
Yeah.
I wonder what. Hold on. Let's look at what like Williams Sonoma.
Well, Costco said 30% of their goods are imported. So Costco actually does a lot of Kirkland brand, which I think is in-house or domestic, and about 60% of those 30% imports come from Canada and Mexico. So Costco is somewhat insulated from their entire business being tariffed.
Williams Sonoma, which is a company that owns, Pottery Barn and what do they own? Williams Sonoma family of brands. Okay, so Williams Sonoma, of course, Pottery Barn Kids, PB Teen, West Elm, Mark and Graham, Rejuvenation. So they own a bunch of these things. They don't own Crate and Barrel. Interestingly enough, not interestingly enough, but just to call that out. They have a lot of products from around the world, and they kind of it's part of their value.
Yeah.
You get a product from them that has a little tag and it says this was made by some artisan by hand in XYZ country.
Like Cost Plus World Market. I don't know if you guys have them up there.
Yeah, right.
Yeah.
They have, this is artisan made and all this stuff, and so that's I would imagine they're hit really hard. Okay, they're percent off high. You want to guess?
I'm going to say 4% down.
Okay, 25% off high.
Oh.
So
Ouch.
They look like, the worst one here on your Mag 7 list is, okay, forget about Tesla for a minute. The worst one here on your Mag 7 list is NVIDIA, down 22 when you stuck that in here. So this one's down more. So that would suggest maybe a little bit of consumer spending, but I would suggest that since February 18th, so February 18th to today, the thing is down 25%. That is solely driven by
Tariff risk. Yeah, look at Target. Right? I know Target is off pretty big too. But it might be in some of their DEI policies. I know a lot of noise, but I would think them, Walmart, and other retailers are especially exposed to imports.
Target's down 40% year to date. Holy crap.
Yeah.
That's just been going straight down all year. 41% off high.
Yeah, if you just look at the consumer discretionary group, it's going to be pretty...
Well, Amazon is actually holding that up, I guess, by being down by 20, because Amazon's part of the consumer... Actually, Tesla's part of the consumer discretionary.
Yeah.
Yeah.
Yeah, so if you look at... I know we got to wrap up. Amazon, Tesla, Home Depot, McDonald's, Booking.
Home Depot, that's an interesting one.
TJX, Lowe's, Starbucks, Nike, who Nike just came out. Yeah, they're going to see shrinking sales and lower margin, like a double.
Oh, sweet. The double whammy.
Yeah. O'Reilly, Chipotle, and AutoZone round out the top holdings of that group.
Nike down 17% off. I'm sorry, Home Depot down 17% off high.
Yeah, lumber, right?
Basis.
Canada ships us a lot of lumber.
God, the sauna I was going to buy was from BC too. Can't do that. Got to buy one from the U.S. now. Look, it's working.
So if you buy something from Canada, you bring it back. You have to declare it, right? Then they tax you at the border.
Well, I'm saying the company is a BC company, so I'd buy it, and it would be obviously lumber from there, and then they would bring it in. So therefore, they're going to have to adjust their prices.
Yeah.
To move it here, but there's a local company which presumably sources lumber locally, and that's the difference.
And to be clear, we're not fans of tariffs, but again, if you're going to slap some kind of regulation, just be clear about it and stick to it.
We'd like that.
Yeah.
That'd be good for us. Be clear. All right, cool. Thanks everybody for tuning in. And we'll catch you again in 2 weeks for another update and hopefully some clarity. One of these episodes will bring clarity.
It'll happen.
It'll happen.
It'll happen, yep.
It'll happen. All right, catch you soon.
Bye.